With the FOMC two-day meeting set to conclude on Wednesday, March 18th, we're going to look at 5 specific areas of the market to give us an idea of the setup before the meeting and, of course, what it may look like after. So we'll look at the S&P 500, XLE Energy, XLK Technology, the US dollar, and Bitcoin. So let's start with the S&P 500. And this is the pattern that's been live now for a few days. And as we can tell, it's bearish in nature. We've been looking at this one as a potential for a while as the S&P was fading up near the 7,000 level when the series of higher highs that were in place from December through January obviously peaked. And then we've had more so of a series of lower highs along the way and most recently lower lows as well. And so far, we've been about 5 or 6 days below this breakdown zone near 67.85 or thereabouts. And it hasn't been a straight shot down, of course. And really the 65.75 level isn't really too far away either. The point being is we haven't seen a downside target get acquired from a bearish formation from the S&P 500 in quite some time. So if that were to occur, and again, understanding that the volatility could definitely pop up once again, it could easily get acquired. And that would be a big change of character since all of the potential bearish patterns that we've seen over the last number of months just all didn't play out. Most of the time, support wasn't even broken. And when those times that it was in November and again in December, it was short-lived, and we were met with a good amount of buying, with those bearish patterns being negated, giving way to another extension higher, and most of the time new highs. And we know those new highs have been marginal of late, and things have been changing, as we know, because when the biggest sectors on the growth side topped in October, they've been underperforming ever since. And so we know from the first part of that, right, from November through the middle of January, that we had extremely strong breadth, historic in some regards. The foundation was as strong as we could remember, with technology not really taking the lead at all, but the S&P still being able to leverage those areas to make new all-time highs, or at least stay near their highs. And so as of right now, the S&P still is within 5% of its more recent high, but obviously hanging by a thread here. So more bad news, of course, could take this down even further, and with no near-term support underneath here, you can easily see how things can get a little more out of hand than they have been so far. And so one way we'll be tracking this is just looking at, again, the number of 1% moves that come into the picture. And there really hasn't been that many so far this year, 9 total, but 6 of them have been to the downside and now 3 to the upside. And on Monday, the 16th, was the first time we had a 1% gain since February 6th here. And right before that, 21st. And both of those came right after, as we can tell, 1% decline. So it showed still back then there was a desire for buyers to step in. So dips were being bought aggressively and right away. We didn't get that snapshot all the way. We didn't get that huge kick to blast through new all-time highs, but again, enough to get it to previous high points near 7,000. That has changed. We have seen pockets of buying along the way, of course, that huge positive reversal that we saw on the 9th, but there's no upside follow through. In fact, it was followed by 4 straight days of losses. So we've seen pockets of strength here and there. We need to see more of that, right? You can't just have one every week or so, which really has what it seemed like it's been doing along the way, and expect this to really turn. We need to get back to what we saw, from the early stages of the comeback last spring, when you have clusters of big moves that just clear out the shorts and increase short covering, and real buying comes. And again, that's how the situation starts, with going from a downtrend to building a small foundation to having bullish patterns form and to have a breakout. We're a few steps away from that, but each one of these potentially good days could kickstart that in the other direction. So that's why we can't ignore that there could be a bigger bullish pattern being formed at any time, right? And as we know, the biggest pullbacks set the stage for the biggest bullish patterns. And even though the one that we're tracking from late October to the end of the year failed, this was still a substantial bullish pattern. We had a marginal breakout, it failed. So maybe the next one could set the stage for a better reaction. And again, this is in no way telling us that this is a bullish pattern formed, but we want to look at it and try to detect the points and the curvature and the structure of this pattern that could eventually get leveraged and turn something like this, basically 3-4 weeks of downward action, into a bullish pattern. And the first step of that is having one of these lows be the low, upside follow through, key higher low, and then combine all of that with the action from before it, and you can see how it could eventually develop into a bullish pattern. Well, if we continue to get bad news because of the war, inflation, Fed, well, obviously then this will fail, right? And so we'll just keep on tracking it as long as this looks viable, and at some point make it violated, and maybe that the key low was much lower than that. But again, we'll know it from the short-term work as well. And so another easy way to track all of this, again, is keeping track of the trading boxes. Initially, we had 2 downside breaks through that 6,800 zone. Both of them saw buying, but that buying has yet to produce any change from just having a lower high so far. So far at this point then, it does appear we have a trading box breakdown for the first time since the one that happened in late March, early April of last year. And so in terms of looking at the go, no-go indicator, this really has been a good barometer that we've been tracking now for a long time. But, we talked about how it got whipsawed a bit in November, went back to go mode, then once more again in December. Then we had another, amber bar or a neutral bar in January. And then, again, it made new highs, but it didn't hold. And from that point, momentum continued to unwind to the point where whatever indicators or factors that this particular indicator is using obviously started to roll over as well. We've seen it in the 20-day moving average. We've seen it in the 50-day moving average. We've seen it in the RSI rolling over. So you can make the assumption that those and others like it are doing the same thing. And so that's just what happens when the market continues to fail. All those indicators that were riding along with it are starting to fail as well. So all of that has shifted this to decidedly bearish now, going on about a month. Now, again, we haven't had the full waterfall decline like we did back in April, but this just tells us that probably should still wait it out to see. And again, this may not turn back to bullish, even if we have a rebound until it gets back up to this point, kind of like here. But it could be worth that wait if you're, again, looking for bullish patterns to form in conjunction with this trend starting to turn higher. And again, that's what we saw in May of last year. So moving on from the S&P 500, we'll look at XLE Energy next. But before we do so, again, if you're enjoying this content, I urge you to check out our free CappNotes newsletter on Substack, where you get all sorts of content from our flagship opening look piece, like the one we put out today, looking at the S&P 500. And again, from different angles as well. One of the charts here, as we can tell, a glimpse of how many stocks are trading below their 20-day moving averages, which has come down, but it's not quite at those big extremes that we saw over the last few years, and what needs to happen in order for that to occur. We've also looked at, again, a deep dive into 1% moves and what that has meant for the market, right? As the bulls continue to search for real response. And then another recent one, weighting the evidence on both sides of the ledger. For every positive, there's a negative. For every negative, there's a positive. That's changed recently, but again, this is a good list to keep track of. So you can check it all out and a lot more on CappNotes. And again, it's cappnotes.substack.com. So XLE Energy, needless to say, it's been doing great. And so these are just a few charts to profile how strong it has been. And obviously to give us an indication if it can continue. So number one, through last week, the weekly RSI got up to 81, obviously strong, with 70 being overbought. If you go back to its history, which goes back to 1999, nearly 30 years of price data. So if you go all the way back to that, only really 2 other times in its history that it had higher weekly RSI readings. The first one here in 2005, as we can tell, was in the middle of the extremely strong run. So simply getting a really high weekly RSI reading did not mean the end was near. In fact, it just gave us an indication that a lot more was ahead. Now, of course, this was a pretty meaty pullback right after it, but big picture, this tells us that a lot is going on underneath the surface, potentially to get an RSI that high, and that it may not necessarily mean the end, but have more to go, which was the case again here. Now, the opposite was occurring in 2011, where after a strong run from the '09 lows to then that did mark a key top, pull back into 2012, but again, overall, still in the middle of an uptrend. So expect some sort of maybe character change now, because we can't expect this kind of pace to continue to maintain an RSI over 80 on a weekly basis, but it could in fact give us an indication that there's another up leg after this. And we can see this here as well, looking at it from a slightly different view. This is the 12-week rate of change, which got to almost 31% through last week. Hadn't seen something that substantial since 2022. Now, again, this was toward the end of that, but the first part of it happened right after the COVID lows, right? About 12 weeks after the COVID low. You might imagine that's when we got that huge move, right? Over 50% higher, just of course, an insane time coming from negative crude oil. Regardless, it once again told us that more was to come. Now, big pullback initially, but created a higher low there. And again, up we went for the next year and a half, 2 years from that point. Go back again to that 2009 area. We just talked about how that produced, it was in the middle of this run. See it from a slightly different angle here. The initial push off of the great financial crisis low produced a very big 12-week run, a little bit of pullback, and then up we went once more. Another indication. So two different ways of looking at it, from a momentum perspective and from a weekly rate of change perspective, tells us that these type of moves don't happen often. And when they do, we should pay attention, because it typically doesn't happen in a vacuum. And the first instance sometimes lead to much higher prices. Now, in terms of versus the S&P 500 clearly rallying, so we started talking about this relative line as it was, starting to emerge. And at the time, just say 2 or 3 weeks ago, or toward the end of last year even, we said it didn't look too different than these other big moves versus the S&P 500 during this downtrend, right? From topping in the middle of 2022 down to here, meaning that it just looked like it may fail once more and this downtrend will continue. But as we can tell, this move now is much bigger than anything we've seen during that time frame, and could very well be one of these, where we saw again in 2020 how it was basically a vertical line for a number of months, held, and then it continued higher. And that whole time here, this blue line moving higher, was when XLE outperformed the S&P 500. And again, we talked about this before. An important part of this was that even though it led to the equity bear market of 2022, initially that wasn't the case. And we had over a year's worth of both XLE leading and the S&P 500 moving higher. Same here, right? From late 2003, early 2004, all the way to the end of 2007, before, of course, the S&P started to roll over from that. So this is something to keep in mind from that perspective as well. So changing gears, XLE, of course, has been the best performing sector by far. XLK Technology has slowly been coming out of its slumber just a bit. So we'll have to see if that can take the next step, because it remains at a very critical spot, right? It's been bouncing near the 135 level numerous times, seeing slight higher lows here. So that's taking the RSI from nearly oversold to nearly 50, right? Now, the bigger picture is that we're still dealing with lower highs based on the spike from that area from late October. As you recall, that was the last time when large cap growth really led, and you see how that happened here, where the XLK has not been back to that point, making lower highs along the way. And those highs have been getting lower, right? And the rallies smaller over the last few months. So seeing that take the next step and overcome, say there's a 145 zone, would be very important. Otherwise, all of this will be at risk again. And needless to say, below 135 is a whole lot of air pocket of life support, as we hear about. And as that's been going on, needless to say, we've been seeing the RSI go from being overbought down. So we still have this negative divergence. You can tell that the RSI itself is in a triangle pattern. And so it's being compressed, momentum is, and one of these has to give way at some point. Where the next time, if this is 135, if we don't see a really big bounce, the buyers may just get impatient, and this could be at risk of rolling over. Now, another way of looking at this is that the pullback over the last number of months has pulled XLK down below its key weekly moving averages. And if we go back to the last few times during this strong run over the last few years, when that has happened, when XLK has either gotten down to the lower lines, the cluster, or below, and or we've seen the RSI get to the midpoint, those have all been very good buying opportunities, as the blue arrows indicate. The one time that did not happen recently was, of course, last February when things really rolled over. And the key part there was that all those lines, and then the faster lines rolled over across under the longer term moving averages. And that's getting close to happening now, where that 13-week moving average is now slightly below 26. And with both of them getting closer to the 40-week, which is like the 200-day moving average. So again, seeing that occur. And sometimes it takes a while for that to actually play out. By the time those did cross, it was near the low. We'll just keep that in mind, because we know it's sitting on support, hasn't broken down yet, even though some areas within it did. Software, of course, being the one that's been in focus. So critical spot. It's a classic buy the dip scenario. If this continues, needless to say, if we see a failure once more, 135, that could be called into question. And so what about XLK versus XLE? You probably understand what this looks like. I think the relative line has been moving lower, and it has been by an historic clip. Not surprising. Again, peaked right when the XLK peaked right when large cap growth stopped going up, when the foundation started to lead. So XLE done the best, but we also had a good amount of support from, early on at least, industrials, financials, basic materials. Now it's really XLE dominating because of what's going on in Iran and the war. Regardless, this is what it's done to the XLK XLE relative line. It's crashing, right? We've had an initial rally here in November, obviously failed through the end of the year, now moving lower. And so we have a slight positive divergence here with it. And we haven't really seen it, a few different spikes here and there, but haven't resulted in the XLK taking over XLE. Now, we just talked about how XLE is very extended from a daily and weekly basis, so it could at least pause along the way. And if that does, and we do see the technology continue to hold at that 135 level, taking advantage of that potentially positive reverse or positive divergence on the RSI, then we could see this happening once more. Now, again, last time it was oversold was in April 2025, and off we went once more. So if we zoom out, it looks much different. Remember, we showed exactly what this looks like, November to March, right? This is November to March right there. So still in an uptrend, XLK versus XLE outperforming it, but this uptrend is getting tested. Now, if you look back all the way to 2000, you forget how well XLE did versus XLK. And of course, this was basically the internet bubble bursting right here. So basically everything, or just say everything, most things outperformed XLK technology, but this lasted all the way until the middle of 2008, meaning that XLE Energy outperformed XLK technology for almost 9 years. The things really turned after that with, that when that actually did turn, XLK then outperformed XLE for 12 years. So the question is this another major turning point where we're going to have a decade's worth of XLE outperforming XLK? Doesn't seem likely, but these massive turns didn't seem likely to point to a huge amount of outperformance in the opposite direction either. Could this go back and forth and not matter anymore? Of course, but I think it's very, very interesting and important to see both sides, both from a short-term point of view and this long-term point of view. Okay, we just have one chart of the US dollar, but I think it's the most important one here. And that is, it continues to challenge this 100 level. And so this is clear resistance, right, that it failed at numerous times already, going back to last May, right? The initial pop, May to June, failed. Came back down, oversold. Now a rally again, back up to 100 in July. Failed once more as it got most overbought. Here it is again, rallying once more into November. Failed once more as it got to overbought. The next rally didn't quite get there. Now we have it again from an even lower price range, ricocheting all the way back up once more. Oversold, overbought again, near resistance again, and this time it has formed a very clear potential double bottom, right? And so, needless to say, if this breaks out this time, it could have a lot of effects on a lot of different areas, not just the US, obviously overseas. We already saw what it's done to precious metals, right, with the dollar rallying like a wrecking ball. And so, needless to say, more than just the dollar is at work here. We have to worry about yields and everything else overseas. But I think this gives us a good indication of how important it is right now. And so, moving on to an area that a lot of people don't care about now, crypto, but I think Bitcoin we can't ignore. Number one, it's been underperforming for months. It's been moving with software, which is trying to rally as well, and it's now trying to negotiate a number of different charts. This first one here is the big bearish pattern that continues to be in play, right? There was a huge downturn, right? When it broke through, say, that 75,000 zone, at the same time, undercut a key uptrend line drawn from 2024. And so came back down and very quickly hit 60,000, now rallying. So is this just one big bear market rally that's just going to get squashed once more? We'll see, because it shows exactly how important it is to get through 75,000, because if it can't, all of this is just still in play, and there's obviously downside risk. Especially important because it seemed to rally after getting down to that 61.8 retracement zone as well. So having that whole thing fail clearly would be a negative. Now, zooming in, these are the things that people are really staring at because it's right in front of us over the last few weeks. It's a potential bullish pattern. It's a cup and handle pattern. It's very similar to the one that ended up not working from November all the way through the beginning of January, where I would argue that this one looked even better, right? More symmetrical, tighter range, really strong potential breakout. If you remember, this was through the mid 90,000s. Got about 2 days of follow through and then completely rolled over, right? To the point where producing extremely oversold conditions. And now once more, having another bullish pattern form, trying once again near that 75,000 level to hold. And if it can, modest upside target, 85,700. More so though, it'll be significant because all the other rally attempts have not even gotten this far. So seeing other rally attempt fail, obviously discouraging, but it keeps the trend in place, a downtrend, where bullish patterns have been failing. We talk a lot about bearish patterns failing from the S&P 500 perspective. This will be a bullish pattern failing within a decidedly strong downtrend line. So seeing one of these actually work out and being chased and momentum flying back into it would obviously be a step in the right direction, not just for Bitcoin, but for some speculative assets as well. And so here's another way of looking at it. We were showing this chart here initially when we started to see the rally in early 2026 because it looked very similar to the April comeback, right? With coming back from a 30% multi-month decline. Same thing here, 36% decline. Coming back from that, forming higher lows is the same pattern we just looked at. Like that is here, right? Busted through the 50-day moving average, held on the initial return to it, and then just got shattered, right, completely. So that failed as this one just completely took off. One of the main reasons is because this was a worldwide event. Like everything rallied with it. For the most part, as this was happening, right, Bitcoin was selling off, it was really just that in software, but it was happening in a vacuum, trying to rally from this after a big downturn. So now we have attempt number 3, now down about 39% from that late January peak. Again, a very big low here, a very important low. February held near 60,000. Here we are once more, attempting to overtake the very steep downtrending 50-day moving average as it's trying to break out from a pattern once more. Needless to say, if this doesn't work, and we see this once more, then any of these perceptive buyers are just going to completely forget about trying to buy the dip or trying to buy breakouts in Bitcoin because it's been burned how many times now on the way down. So this goes to show how important it is for right now. Okay, one last chart for Bitcoin, slightly different way of looking at this. And we're just trying to pinpoint here the extreme highs and lows of the weekly RSI going back to 2020. And so, as you can tell, these did not nail the lows or highs of the index, but it did show us how momentum has gotten washed out. And it wasn't the best time to then buy when it was at extreme high for the RSI, even though we went higher, eventually wore off, right? A lot of back and forth movement. The extreme move was behind us, and it was just led to a very volatile price action through 2020 or the beginning of 2022, and then the rollover. Same with the June 2022 low point in the RSI. It wasn't worth selling it anymore down there because even though it went lower, it didn't have much lower to go. Brings us to March 2024, about a month before the halving, remember? So people were expecting a much higher rally. And so the thing is, though, the best part of this move was over when this ticked to 88, the RSI, and they started to roll over, where, again, continued the rally, had a good amount more on a percent basis to go, but it was just a lot of back and forth movement with false breakouts reoccurring before the top was in. So that brings us to right now, where the most recent pullback has now brought it back, the RSI, back below 30 to 26, right? The lowest level since hitting 25 or just under 26 in June of 2022. So does this tell us that, it's not a good time to sell anymore, even though this may not be the bottom? Could be. So we'll see how this plays out over the next few months. Point being is, if we don't see a new low in the RSI, say 2 months from now, as Bitcoin is maybe hovering 60,000, 50,000, it could tell us once more the momentum is now depressed to the downside, and we could see a real buying effort at that time relatively soon. So we have for today. Don't forget to check out these other videos we have here. Talk to you next time. Thank you.